Good afternoon, everyone, and welcome to Kentucky Small Business Development Center's Wednesday webinar. While we give everyone a moment to connect, we'd like to share some information about the Kentucky Small Business Development Center, or Kentucky SBDC for short. So we have 10 centers statewide that serve all 120 counties in the Commonwealth. The Kentucky SBDC's professional staff has a wide array of knowledge in various industries, which allows us to offer a customized service that meets your particular business needs. We provide no-cost assistance in areas such as market research, feasibility studies, business plan development and execution. We help with financial modeling and projections, and we also help in identifying pre-venture or growth capital for your business. Our program is co-sponsored by the Small Business Administration and administered by the University of Kentucky in partnership with regional universities, community colleges, as well as the private sector. So we're part of a national network known as America's Small Business Development Centers, which provides service to every county in the U.S. To learn more about us, visit kybizhelp.com, or you can go ahead and request personal assistance by calling 1-888-475-7232 or email info@kybizhelp.com. In addition, you can connect with us via Twitter, LinkedIn, Instagram, and Facebook. You just search Kentucky SBDC on each of these platforms to connect. A recording of today's webinar will be emailed to you. So if you have trouble with audio or just need to step away, know that you'll have access to the entire recording. I'm Janet Flaw with the Louisville Center, and leading today's discussion is David Etkin, our Center Director in Louisville, and Tony Sears, our Assistant Center Director in Louisville. Good afternoon, Dave and Tony.
Hey, Janet.
So what are we talking about today?
Well, we're going to talk about exactly what is on everyone's minds these days, and that's the Paycheck Protection Program. And I just want to say to our two presenters today, Erica and John, you met them, if you were here last week, then you met them last week, but we were just blown away with the amount of information that we got. And as you know, with the SBA, it's a moving landscape, and every day is different as new rules come out. So we thought, based on the number of questions that we got over the last few days, that it would be great to have our two resident experts from Dean Dorton come back and visit once again, because I don't know about you guys, I have a ton of questions. We get questions every day that we can't answer. So I know that there's a lot of movement here, but our two experts hopefully can kind of help us out and tell us what they've found out so far this week and what they know now. So Erica, tell the folks a little bit about your background and your role there.
Yeah, so I am an associate director of tax services. I'm actually a state and local tax consultant. I don't do tax returns. I don't know how to do that, ladies and gentlemen. We have lots of people who do, though. I do mine on TurboTax because until I joined Dean Dorton, I refused to pay anybody else to do them. I was in public accounting right after I graduated from college, stayed 4 years, went to law school, practiced law for 25 years before joining Dean Dorton. So I have an extensive business background, and I have absolutely loved my time at Dean Dorton. I work with fabulous people like John Wertenberger, and John is relatively new to the firm. He can tell you about that, but it's been a pleasure getting to know him despite the ugliness of this process, Dave.
Hey, John, glad you can make it again today.
Yeah, no, that's right, Erica, and thrilled to be here. Just like Erica said, a little bit about myself. Grew up in the Louisville, Kentucky area. Went down to the University of Kentucky. Don't hold that against me if you root for another state college team. But went to the University of Kentucky, went into public accounting right after school. And then, as Erica alluded to, have recently joined Dean Dorton from a larger public accounting firm, and have gotten involved in the CARES Act really through, I feel like it was a self-inflicted process.
Well, you volunteered.
I kind of did. I kind of just dove in because I wanted to understand it, and then it evolved from there. So currently with Dean Dorton, I'm a director of assurance services, more on the audit side. So audits, reviews, compilations, assisting companies and consulting smaller businesses and providing consulting and advisory services. So over the past, I would say, what has it been? A month and a half, 2 months almost, Erica, I feel like our lives have been consumed with the CARES Act and specifically the PPP loan section and some of the Main Street lending program loans that are coming out right now. So, like I said, happy to be here and look forward to the webinar and your all's questions.
All right. Well, I think that we should just get right into it. So, Erica, you want to pull up our slides here for me? There we go.
All right. So good afternoon, and thank you for having us back. Now you know all you need to know about me and John. Here is the recovering lawyer disclaimer. These several things. I mean, really and truly, this is your business situation. Your individual situation is specific to you. And every accounting, tax, legal, whatever you want to call it, question typically is very fact specific. So this information is general in nature, and you should talk to your CPA about your specific situation or seek the guidance from somebody at the SBDC. Also, just like last week, there is very limited guidance on how to do these forgiveness calculations. John and I have been reading this stuff over and over and over again. We've also been reading what other people have written to see what their thoughts or takes on it are. We still are waiting for guidance from the SBA. I cannot imagine that there won't be an interim final rule. I mean, they've promised an interim final rule devoted solely to forgiveness that'll include some examples that'll help us with a lot of our questions. But right now, this is based on the language of the CARES Act and whatever couple nuggets here or there that might be buried in a frequently asked question or another interim final rule.
Hey, Erica, let me just jump in here real quick and just say that for those listening in, we'll turn on the chat function here shortly. But as we go through this, jot down your questions. We'll spend as much time as we can answering your specific questions. Type those into the chat, and we'll open that up here in just a couple seconds here, a couple minutes, and just type in your questions. The questions we can answer in the chat watch, we'll answer those for you, and then at the end we'll read those out to Erica and John and get their opinions on what your questions are. So
okay, so what we're gonna do this afternoon is we're gonna talk a little bit more about the specific elements of the costs that are forgivable. And then we're going to do a deeper dive into what a couple of these things mean in terms of full-time equivalent reductions or salary and wage reductions or eliminating those reductions. Again, not based on anything specific that we have that we can point to, but based on a continued reading of both the materials that we do have and others. So you'll remember if you were here with us last week, or if not, there are a limited number of things that you can spend your Paycheck Protection Program loan, PPP loan, those proceeds on. They include payroll costs, and then we'll call them covered interest on covered indebtedness, rent, and utilities. And we're going to look at the definition of each of those just slightly. You have to spend to maximize your forgiveness 75% of those on payroll costs, 75% of, we're not sure, either the proceeds or we think it's going to be forgivable, total forgivable costs. That's what makes the most sense. But again, that's an open question. And you need to, and John, we're going to spend more time today talking about these two bullets, third and fourth bullets on the page, in terms of how to maintain, or what it means to quote unquote maintain these levels. And then on documentation, we're not going to spend much time on that today at all, but no documentation, no forgiveness. You're only forgiven for what you can document. So you want to be very careful and make sure you capture all the information so you're not penalized just because you don't have a piece of paper. So, as I mentioned a second ago, here are those forgivable uses or costs. Payroll cost, which has a definition all of its own. Interest on what I'm calling secured debt. We're going to talk about what that means. Covered rent and covered utilities. All right. So Dave sent us the questions that were left over from last week that they were able to capture. And so we're also building on some of those questions. One of the questions is, what is exactly included in payroll costs again? So here's that quote unquote definition. So it's your employees, their gross wages, plus payments you make for their health care and retirement benefits, plus state and local unemployment taxes. When you think about gross wages, if you think about what the amount on which you pay the employees, the total that's on your Form 941 at the end of the year, that's on their W-2, that's what we're talking about. So if they're out on sick leave or vacation leave or any of those things are included. What is excluded is the employer's share of FICA and federal unemployment taxes, although it's actually insurance. We call them taxes. And then I'm going to talk today about self-employed individuals. And one of the reasons is because the only guidance we really have applies to a self-employed individual that is filing a 2019 Form 1040 Schedule C, has either already filed it or will file it this year. The SBA issued an interim final rule, an IFR, the third IFR. There are 7 now. And in that IFR, they talked about how you would calculate the maximum loan amount if you were a Schedule C filer, B, how you can spend your monies, and C, forgiveness. So we're going to look at that because that's added some flavor that we're not always exactly sure what to do with. So if you are one of those folks, payroll cost would include any employees, all the things above, plus line 31 net earnings times 850 seconds, which is up to $100,000. Up to $100,000, it's 15,385. 8 over 52 is 0.15385. And so that's likely different than the draws you take from the company, or guaranteed payments for limited partners or LLC members, etc. So that is an interesting calculation and perhaps not what everybody's expecting. Okay, here's where our first set of problems have begun. So in the section of the CARES Act 1102 where the program is set forth, it talks about interest on indebtedness secured by a mortgage. And then in the section on forgiveness, which is section 1106, it talks about what you see on this slide: indebtedness or debt instrument incurred in the ordinary course of business. That's a liability that is a mortgage on real or personal property. So in section 1106, they add personal property. That's not in 1102. And then was incurred before February 15th. You're going to see that that's a common theme. So people have asked questions such as, if I finance my inventory, say I'm a truck dealer, and I finance my inventory through floor plan financing, is that the equivalent of a mortgage on real property, on personal property? The absolute truth is I don't know. It certainly looks that way. the National Automobile Dealers Association has said they're not sure either, but they're looking for clarification on that question. So if I'm in the truck dealer and I have all my trucks, do I get to include that interest? I think so. And then it becomes less clear, or maybe more clear, when you look at what the SBA has said about Schedule C filers in the third IFR. So in illustrating this item, they say it would look like interest on a mortgage for a warehouse used to store inventory, or interest on an auto loan if that auto is used for business purposes. Also, for all these Schedule C costs to be allowable and forgivable, they have to be costs that you would deduct on that Schedule C. So if you have an automobile, but you know that you use it 90% personal and 10% business, and you didn't want to run the risk of including it in your Schedule C, you just decided just to eat that costs, then you would not use interest on your auto loan. But if you do expense a percent of your auto for business purposes, then you would take that same percent and apply it to the interest, and presumably that's covered, allowable, and forgivable interest. So the first bullet is the interest on the mortgage for a warehouse. That warehouse is real property. Just like if you have if you have a home and you have a mortgage on your home, and then the auto loan is personal property. All right. Rent. Covered rent. Rent obligated under a leasing agreement enforced before February 15th. There's that date again. And then here are the examples in that third IFR of things that constitute rent. The warehouse where you store business equipment. So that assumes that you don't have a mortgage, because if you have a mortgage, you own it and you're not paying yourself rent, presumably. And then the vehicle you use to perform your business. So if you're making payments on your car, either lease payments or, yeah. John, that's interesting. It just occurred to me that you could lease your car and deduct the payment, but if you own your car, you can only deduct the interest. Oh, see, guys, I'm really sorry in advance about this living nightmare that we call paycheck protection loans. People, listen, all I can say for John and for us is we understand your pain, okay? We're there with you. So anyway, let's pretend that we're leasing our car now, and you deduct those lease payments. Can you do that? Remember, I don't do tax returns. That you deduct those on your Schedule C, then under this third IFR, you would be allowed to deduct that that lease payment. I can almost promise you, although we all talked about how dangerous it would be to guess what Congress's intent was, or at the time they passed it, but I'm pretty confident that this rent idea that we've got going on here was not the intent, because it opens a really big hole. Lots of things could go under that rent column. Covered utilities. We put on the slide what's actually part of the definition of utilities, because you've asked, and we get that question a lot. On the 2019, on the third IFR, where they're talking about Schedule C filers, they talk about electricity for the warehouse or gas you use driving your business vehicle. I guess that means gas is transportation. We were asked yesterday if you have a fleet of delivery vehicles, or is the gas for all those delivery vehicles a forgivable cost, that's the type of not abuse, because that's not the right word, nor is loophole. I mean, they're the ones who created it. But that's the kind of unintended consequence that I think this third IFR will give way to. I don't think that that's what Congress meant, but nevertheless, if you're filing a 2019 Form 1040 Schedule C, or you already have, then by golly, if you deduct that on your Schedule C, there you go. That is the rule. So because I think these rules are a little suspect in the sense that that's not what Congress intended, I'm hesitant to suggest that if you're in a different business entity form, if you are a partnership or a multi-member LLC, an S corp or a C corp, actually a corp, then I don't know that I want to borrow this language and take it into my business. Typically, that's exactly what we would do. What's good for the goose is good for the gander, right? But I'm just a little leery of that. And I know that you've already experienced this, but there's no reason that I mean, it's entirely possible that this could be changed. And so this might not turn out to be true even for folks who file a 2019 Form 1040 Schedule C. So yeah. So that gives you a broad overview of what constitutes payroll cost and the other items that are forgivable, and how some of the confusion is coming up related to, can I deduct my lease payments? Can I deduct my utility payments? Can I deduct my gas? What constitutes utilities? So that's the basis. And now I'm going to hand it over to John, and he's going to talk to you about, okay, we finally figured out what forgivable costs are. Now what do we do?
Yeah. Thanks, Erica. And maybe the only thing I'll add to kind of the whole transportation theme that you just discussed on the previous slide was, we don't know, and Erica's exactly right. You don't know if you can translate that Schedule C guidance that came out in that third interim final rule to a business. And even if you did, you don't know to what extent that is going to be further clarified later on. So you don't know if it's going to be, in Erica's example about fleet of delivery trucks, if the gas used in those fleet of delivery trucks is going to be treated differently than the gas used by maybe a company car that's utilized by executives who are driving to and from work from their personal homes, right? You just don't know. So on the earlier point of documentation, I think my suggestion at this point would be document everything. Make sure that you're keeping records of what the fuel was for those company-owned cars and the fuel for the fleet of delivery vehicles. And depending on what the new guidance says when it comes out, you may be able to deduct both, or one of them, or none of them. So we'll just have to wait and see. And I was laughing to myself as we were going through the earlier slides, because I feel like that both Erica and I last week, when we were doing the presentation, I know I was clicking refresh to see if new guidance was coming out as we were given the presentation. And I would have hoped, then after the presentation, Thursday went by, Friday went by, Saturday went by, we were all waiting new guidance, and here we are a week later and we still have the same guidance. So hopefully stuff gets released soon. Erica,
I figured it out. Okay. The guidance will come out after the first group of people have filed their applications for forgiveness. That's when the guidance came out about how to calculate payroll costs.
Yeah, so
that's true. That might be the answer, or when we hang up, one or the other, right?
That's true. All right, I digress on my little tangent there. So on to the covered period. So we covered, what this meant last week, but just for a quick refresher, the covered period when you're thinking about forgiveness of a loan is the 8-week period that begins on the date of disbursement or origination of the loan. So whenever the lender gives you those loan proceeds, and those loan proceeds hit your bank account and you're able to utilize those proceeds, that's when your 8-week period starts. So take 8 weeks from that date, and that's going to be the end of your 8-week period, and what's referred to as the covered period when you're thinking about forgiveness. Some examples here. loan, say you're a borrower and those loan proceeds hit your bank account on April 15th, 2020. You would take 8 weeks from April 15th, 2020. That would be your start date, the date that they're available for use. And you would say, in order for those proceeds to be spent and eligible for forgiveness, you must spend them by June 10th, 2020, which is going to be 8 weeks from that April 15th date. There's also the concept of a covered period, and we'll get into it here in just a minute, for just the general use of the loan proceeds. And what is in the CARES Act right now as far as general use ends on June 30th, 2020. So what that means is essentially if you're a borrower and you've received your funds on April 15, 2020, you need to use those funds by June 10th, 2020 in order for them to be eligible for forgiveness. If you don't spend all of those funds, you still have until June 30th right now, 2020, to spend the rest of those funds on allowable uses. And those allowable uses are some of the ones that Erica covered previously. Now, great example of what we expect to come out in the revised guidance is we fully expected there to be an extension of that June 30th, 2020 allowable general use date. For example, if you look at the second example on the slide here, say you're in the second wave of the PPP loans and you didn't get in the first wave, but now you've applied, now that there's been increased funding and you're waiting on your disbursement of the loan proceeds from the lender. You haven't got that yet. Say that comes tomorrow. Well, if that comes tomorrow, then your 8 week period is going to start tomorrow, and backing up, going 8 weeks from tomorrow, you may be looking at July 2nd or July 1st to spend those proceeds. And so that's going to extend beyond June 30th right now, 2020. And so just conceptually, if you take a step back, that doesn't make a lot of sense. They have to extend this June 30th date in order to allow for people who haven't received their disbursement yet of their loan proceeds to be able to at least spend it within the 8 week covered period. So to what extent they're going to extend those dates, we don't know yet. Is it going to be September 30th? Is it going to be the end of August? Is it going to be the end of July? We don't know. We just know that there has to be an extension of June 30th.
Yeah, so just as an aside for the participants, if you're still paying attention and you can count or use a calendar, if you get it tomorrow, your date expires the 2nd. If you get it today, the date expires the 1st. This is what happens when you're in a hurry. You can accidentally get the wrong date. So count your own days. That was in last week's session.
That's right. All right. So limitations and reductions. So this is something that Erica mentioned earlier, and when we were talking about how to maximize your loan forgiveness, and we mentioned to the group that we would spend a little bit more time on this. Erica already touched on the 75% rule to a certain degree earlier in the deck, and I'll just reiterate a couple of points there. As she mentioned, the first interim final rule stipulates that at least 75% of the loan proceeds must be used on payroll cost. That didn't exist initially in the CARES Act. That came out and clarified based upon discussions between the Treasury and SBA subsequent to the initial CARES Act signing into law. But it's clear that what they say is at least 75% of the loan proceeds must be used on payroll cost. So does that mean the full loan proceeds? Is that translatable to the forgiveness amount, what you're using that money on that's forgivable uses? Well, the first interim final rule also states that from a forgiveness perspective, not more than 25% of your forgiveness amount should be used on non-payroll cost. So indirectly, if you look at your forgiveness amount that you're going to be using that during that 8 week covered period, at a max, 25% is going to be related to non-payroll costs, and indirectly 75% is going to be made up of payroll costs. So we know that 75% rule both applies to the loan proceeds as well as the forgiveness amount, what you're spending and what's eligible for forgiveness. What we don't know right now is whether that's a percentage limitation or if that's an all or nothing or a cliff ramification if you don't hit that 75% threshold. So say you get your loan, you spend all your money during your 8-week period, and you're only able to get to 70% of payroll cost. Well, we don't know if they're going to look at that and say, well, you didn't hit 75%, so none of your costs are forgivable. Or they're going to look at it and say, well, you didn't get to 75, but you got to 70, so we're just going to reduce your forgiveness amount by 5%. We don't know that at this point. You have to imagine that they wouldn't take the all or nothing approach to where they're going to just burden all these borrowers with additional debt that they're not going to allow to be forgiven by using an all or nothing approach. But we just don't know. And that's one of the things that people are stipulating if you go and you read other articles that are out there at this time. But that will be, I would assume that will be addressed in the guidance that we're awaiting on. So that's the limitation piece here. From a reduction standpoint, the CARES Act goes into 2 potential reductions when you think about your forgiveness amount that you've spent during the 8-week period. There's one reduction that relates to a reduction in full-time equivalent employees. That is a percentage reduction. And we'll give some examples about these later on so that they're a little bit more clear. But the main point is that's a percentage reduction for any reduction in full-time equivalent employees. And then the second is a reduction in salary and wages for eligible employees. That is a reduction greater than 25% for each individual employee. And that is a dollar for dollar reduction. So we'll go into a little bit more detail about how to specifically calculate those on this next slide right here. So as I mentioned, the percentage decrease or the decrease in FTEs is a percentage amount. So how do you calculate that? Well, you take your full-time equivalent employees during your 8-week period. That's the numerator in your percentage. The denominator is going to be your average full-time equivalent employees from your base period. You get a couple options there, and I'll go over exactly what those are in the next example. And then simply you come up with a percentage amount and you multiply that by your forgivable cost. And that's going to be your reduction in your potential reduction in your forgiveness amount. So in an example, and I'll go into one here, but just simply put, if you have 8 during the covered period, you have 10 in your base period, that's 80%, 0.8. You're going to take 1 minus that 0.8, and you're going to have a 20% reduction in your forgivable costs. So we'll go into an example in further detail, but that's the percentage reduction related to FTEs. The dollar decrease for eligible employee salary and wages in excess of 20% and 25% is a dollar for dollar reduction. So if you have an employee making X and that employee made less than X times 75% during the covered period, it's going to be a dollar for dollar reduction. So, and in each one of these scenarios, it's going to be the 8-week covered period compared to an applicable base period that's defined in the CARES Act. And there's some questions on that base period. So we'll get to that, and I'll highlight that in just a few slides. But for now, we're going off what's in the CARES Act and the limited information that we have in those subsequent IFRs. So here's going to be our first example. And we thought, based upon the feedback that we got in last week's webinar, as well as some questions that came out, that it might be helpful just to put an example out there with some numbers to help people understand. So we're going to assume a few things here based on this example. One, it's a non-seasonal business. The loan amount that they received was $200,000. The forgivable expenses, they're at the end of their 8-week period at this point. They're looking back, they're saying, okay, I spent $180,000 during my 8-week covered period on forgivable expenses. So that you're going to start there from a forgiveness standpoint. And then they're going to look at their average monthly FTEs. And they're going to calculate, do I have a reduction in my forgiveness amount of $180,000 or do I not? So in this example, during the 8-week covered period, they had 35 full-time equivalent employees. Since they're a non-seasonal business, they have the option of choosing one of 2 base periods. Those base periods are either the February 15th, 2019 through June 30th, 2019 historical period, or the January 1, 2020 through February 29th, 2020 period. So if you go off 2019, they had 50 FTEs. If you go off 2020, they had 40. Most of the time, I would say most, but I would advise all of the time, if you are a non-seasonal business, to use the lower of the 2. Technically, you have the option of which one you want to choose. If you use the greater of, it's going to result in a larger reduction. So nobody wants to do that. So the question here is, what's the reduction to the forgivable cost as a result of the decline in FTEs during the covered period? Well, the answer is 22,500. And Erica was laughing at me for my ability to put in this
No, I'm jealous.
algebraic equation into my PowerPoint slide. But I tried to lay it out so that somebody could look at this and understand exactly how we got there. So you take that 8-week covered period, as I mentioned on the previous slide, that's going to be your numerator. You're going to take the lesser of the 50 or the 40 in this example, because you're a non-seasonal business, which is going to be 40. That's going to result in a factor in this case, and you're going to take 1 minus that, and that's what you're going to multiply by your 180,000 forgivable expenses. And the result of that is 22,500. So if you started off with forgivable expenses of 180,000 and you have a reduction of 22,500, now you're going to have forgivable expenses. If I'm doing my math right here, I hope, what is it, 157,500?
Here, I'll do it. Let me get my calculator.
I think I'm pretty good at 157,500. Erica, you can check me on that.
Yeah, well, I'll tell you what, John. My high school math teacher daughter would be very proud of your algebraic equation in your slide. So
yeah,
you're 100% correct, sir. 157,500.
Good. I'm glad I didn't screw that up on the live webinar. But so just one point to drive home here in this example. I keep on mentioning non-seasonal businesses, right? You have the option of one of those 2 base periods. If you're a seasonal business, which if you've already gone through the PP loan application, and you should have determined whether you're seasonal on the front end during the application process. But if you're a seasonal business, right now the CARES Act limits you to that 2019 base period. So your calculation is going to be from February 15th, 2019 through June 30th, 2019. So in this example, you're actually going to have to take that 50 as your denominator in the fraction, which is going to result in a higher reduction amount. So just something to keep in mind as you think about seasonal versus non-seasonal.
Hey, John, is there any reason I can't just take the fraction and multiply it by my forgivable cost instead of doing that 1 minus business?
Well, if you just take the fraction in this example, you're going to result in about 87.5%, I think, maybe, of the 35 divided by 40, and you're going to take that by your 180. That's not going to be your reduction amount. You can still take that amount, and that might be your forgivable. That might be your forgivable. Your new forgivable amount, but it's not going to be your reduction. So if you're calculating what that reduction dollar amount is, you got to make sure you take that 1 minus.
Got it.
Okay, some key reminders here. Some of the stuff I've already covered as I talked through that example with the group, but only include employees of the business when calculating your full-time equivalents. Don't include people that you furloughed temporarily at this point. Those people are likely receiving unemployment benefits, which means that they're no longer an employee of the company. So make sure you're only including employees of the business when calculating your FTEs. Calculate the CARES Act specifically talks about the average monthly FTEs. So it goes on to state that you're supposed to use each pay period that falls within a month to calculate what that average monthly FTE is. So quick example of that, and I hope this doesn't confuse everybody, but if you've got 5 pay periods, 5 payrolls, I guess, in your 8-week period, 3 of those occur in the first 4 weeks, 2 of those occur in the second 4 weeks. You're going to take the average of those 3 pay periods for your first monthly average amount, and then you're going to take the average of the 2 pay periods for your second monthly average amount. You're going to average those 2 monthly averages to get your average during the 8-week covered period. Lots of averages in there, but keep in mind, it's the number of pay periods that fall within a month. So seasonal businesses, as I already mentioned, have to use February 15th through June 19th, or February 15th, 2019 through June 30th, 2019 as your base period until further clarification comes out. They could change that. We saw some changes to those initial date ranges in the CARES Act on the front end during the calculation of your loan amount. So we don't know if there's going to be changes for the forgiveness, but there could be. As a reminder, it's a percentage reduction to your forgivable costs. It's going to result in a dollar amount, but it's a percentage reduction, and it can only reduce your forgivable cost. Might seem somewhat obvious, but some people might be sitting out there saying, wait, I have a higher FTE count than I did, during this 8-week period than I did during my historical period. Does that mean for some reason I get money back? No, you can only be forgiven for your loan amount plus any accrued interest. All right. Second example here. So this is the salary and wage reduction example that we've been talking about. Going to assume some similar characteristics in this example. PPP loan amount of $200,000. Your forgivable expenses, again, during that 8-week covered period are $180,000. So for salary and wage reduction, it's on an employee by employee level. And it's only for eligible employees. So quickly, what's an eligible employee? Well, an eligible employee is essentially any employee that didn't receive a paycheck in 2019 that annualizes to above $100,000 when considering their salaries and wages. So initially, when I read that, and Erica, you can chime in if you want to add anything here. Initially, when I read that, I said, well, shoot, that doesn't make a lot of sense for employees that received a bonus in an initial pay period during 2019. Like if you annualize whatever that bonus was, that's going to result in higher than $100,000 potentially on an annualized basis. But then it says salaries and wages. So the way I read that is salaries and wages is going to be your base salary or your base wage rate. It's not going to include any potential bonus. So for any employee that received an annualized salary rate or base rate wage in any given pay period in 2019 that annualizes to more than $100,000, you're going to exclude them from this calculation. So in an example where maybe an employee started off in 2019 getting at a rate of $95,000 a year, and then they got a pay raise during the year, and that brought them to $105,000 a year, you're going to exclude that employee because later on in the year when they were making that $105,000, it was annualized to greater than $100,000. All right, so once you have your eligible employees, the example here gives two different examples of two employees. You have employee number one, who in the most recent full quarter, which is the base period for the purposes of calculating the salary and wage reduction, received total salaries and wages of $15,000. During the 8-week covered period, they made $9,000. Employee number two, during the most recent full quarter, made $10,000. During the 8-week covered period, they made $8,000. So what's your reduction? If you're looking at this by employee basis, what's the reduction in the forgivable costs as a result of the declines that you're seeing in the most recent full quarter versus the 8-week period for these employees? Well, for employee number two, the answer is simple. It's zero. Their reduction, if you just look at 8,000 compared to 10,000, is a 20% reduction. It's not greater than 25%. So if you're at a reduction that is less than 25%, equal to or less than 25%, you're okay. No forgivable cost reduction. However, in the example for employee number one, their salary and wage reduction was 40%, 15,000 compared to 9,000. So how do you calculate what that dollar amount is that's going to come off of your forgivable costs? Well, the simplest way I think to think about it is just take 15,000, what they made in that most recent full quarter, multiply that by 75%. That's what they could be making during the 8-week period, and you not get a reduction for it. And then take the difference of that versus what they actually made. And what that results in is $2,250. So that would come off your $180,000, and you would be left with, again, $177,750. Hopefully that makes sense. I think, again, Dave, you can correct me. I think we may send out these slides on the back end of this. So if you didn't catch all that, you're going to have time to digest it on the back end when you're reviewing these slides.
Yeah. So John, just tell me again, how do I get to 2250?
So you would take your 15,000.
Okay.
And you multiply it by 75%. So essentially the standard says that if you have a salary and wage reduction greater than 25%, that's when the reduction kicks in. And so you're allowed to reduce an employee's salary to 75% of what they were making and still be okay. So you're going to take that 15,000 times the 75%. Then you're going to take the difference of what they made actually during the 8-week period.
So actually you're taking that. So they made $6,000 less. You're taking that 6,000 over 15 to get 40%. Is that right?
So what I'm doing, yeah, well, that's essentially, yes. That's how I'm calculating the 40% initially to say that, yes, it's greater than 25%.
And then you multiply that 40% by the $6,000 decrease.
Yes.
And then is that the amount of the reduction?
Well, you're taking, I don't know that you're taking the 40% times the 6,000
No, we're clearly not.
That's going to result in a higher amount. So
Yeah.
you're saying, what am I allowed to pay the employee and not get dinged for a reduction? And that's going to be your 15,000 times your 75%. So if I'm just doing that quickly on my calculator here, that's going to result in $11,250. So if I paid that employee $11,250, it would be similar to employee 2.
Yeah.
I would have zero reduction because my reduction amount would actually be 25%. And the standard stipulates that any reduction in excess of 25% is where the dollar for dollar reduction calculation starts to kick in. So in this example, if they made $15,000 in the most recent full quarter, I can pay them $11,250 during the 8-week period and not get dinged for a reduction. However, I paid them $9,000. So I paid them less than what that 75% threshold was. So the difference in what that 75% threshold is and what I actually paid them is going to be your dollar for dollar reduction.
That's it. Thank you.
Mm-hmm.
Could be simpler, ladies and gentlemen. Could be simpler.
That's right. That's right. All right. So what are some key reminders when thinking about the salary and wage reduction? One, it's based upon individual employees. So that's different from full-time equivalent employees. So keep that in mind. Two different things when you're thinking about how to calculate the FTE reduction and the salary wage reduction. I already talked about this, but you want to exclude individual employees who received during any single pay period in 2019 annualized salary and wages. I think of that as excluding bonuses in excess of $100,000. The comparable period, as I mentioned, or the base period, is actually defined as the most recent full quarter during which the employee was employed before the covered period. We don't know exactly how that is defined right now. We don't know what that full quarter is. That could be January 1, 2020 through March 31, 2020. That could be the most recent full quarter for the respective company's fiscal year end, as that relates to if you're not a calendar year end company. So we're waiting on guidance to see exactly what that looks like. If you think about what the CARES Act did initially on payroll costs, it talked about calculating the 12-month, average from right before the borrower received the loan funds. And then they changed that to 2019 for the 12 months of 2019. So could the full quarter be the last fourth quarter of 2019? Could be. We don't know at this point. So we're waiting on guidance of what that's going to look like. You're supposed to use total salaries and wages for each period. So whatever you're comparing that base period for that full quarter, as well as the 8-week covered period, total salaries and wages, not an annualized amount, total salary and wages for each employee. And then another feeble attempt just to add some color to the slides here. Reduction less than or equal to 25%. That's good. That's the green. A reduction greater than 25%. That's going to be bad. That's going to result in a reduction to your forgiveness amount. So what are some current questions here? Because there's a lot actually, and I didn't want to burden the examples and the key reminder slides with what our questions are, but I kind of alluded to what that most recent full quarter was on the previous slide. But how's an FTE defined? We don't know at this point how an FTE is defined. The IRS would define an FTE, and I think Erica brought it up yesterday on our presentation that we did, that she actually found some guidance. I think was it in the Small Business Administration?
Yeah, so it's a number that the SBA uses for the Affordable Care Act.
Yeah, okay.
Our colleagues may know that it's 30 hours for a full-time equivalent.
Right. So that's out there from any employee that's working 30 hours or more. What about employees that are out on family leave or medical leave who are still receiving compensation as a full-time employee but aren't working 30 hours a week? Are they going to be included in the calculation of FTEs or not? We don't know at this point. So we're waiting to see how that's going to be defined. It was brought up, I think, on the last week's webinar. What about voluntary terminations or retirements? What about if I have somebody who just left? And do I get dinged for somebody leaving voluntarily or retiring? Well, we don't know at this point. We don't know if you're going to be required to bring somebody on to replace that individual. So that's to be determined. I already mentioned what's the most recent full quarter. When you're thinking about what the most recent full quarter is, you might take a step back and say, wait, a quarter is 3 months, which is 12 weeks, and I'm comparing total salaries and wages from 12 weeks to 8 weeks. How does that even make sense? I'm comparing apples and oranges. You're right. You're right. It doesn't make a lot of sense. You're instantly at a shortfall. So we're waiting on some clarity as to exactly how that reduction amount is going to be calculated. And then what about bonuses, hazard pay increases? As people think about comparing wages from 12 weeks to 8 weeks, they quickly realize, well, shoot, if I keep my pay the same, I'm less than 75%. So I've got to do something. I've got to increase pay. I've got to, hazard pay or bonuses or pay increases. Are those allowed? Right now, there's nothing that specifically prohibits those from being used, or the proceeds from being used for bonuses or hazard pay or pay increases. There's nothing that specifically allows it either. So the best thing that we can say is just be mindful of the $100,000 annualized threshold that exists during the covered period for each individual employee. Payroll costs are the same as defined during the covered period for forgiveness as they are on the front end. So make sure you're not paying any individual employee in excess of $100,000 annualized during the covered period. And then think about how it might be viewed from a qualitative aspect on the back end. When you're submitting your supporting documentation for loan forgiveness, could somebody look at it differently if they see a big bonus paid during one pay period versus maybe a ratable pay increase over the covered period? We don't know at this point, just some thoughts to think through. And then there's probably some other questions out there, and I'm sure you all are going to raise those that we haven't thought of. Those are the question marks at the end there. So very quickly, because I know we're going a little bit over here and we want to allow some time for Q&A, but we mentioned this exemption, this rehire exemption that exists within the standard. And I'm not going to spend a lot of time on this because quite honestly, it doesn't really make a lot of sense. And if you sit down and you try to calculate it, you'll quickly realize that you might be able to get there on the FTEs, but once you get to the salary and wages, it's really, really difficult without making a lot of assumptions. So it really doesn't even make a lot of sense. But the way it's worded right now in the CARES Act is that essentially if you have a reduction in FTEs or salary and wages for an employee that occurred between February 15th and April 26th, and you eliminate that reduction, meaning you either rehire that employee or another employee, or you increase the salaries and wages of an employee to what they were as of February 15th, 2020, it's going to be almost like that reduction never happened. You're going to be exempt from that. So the main point, as Erica mentioned earlier, is try to maintain those historical levels for average FTEs and salary and wages for each individual employee during the 8-week covered period. That's the best way we can tell you at this point to try to potentially avoid a reduction in your forgiveness amount. How to exactly do that calculation, we very much anticipate that there's going to be released guidance in the next wave that's going to tell people exactly how to calculate this potential exemption amount. Erica, you want to cover just some document items?
Well, very quickly. So, and we talked about this week, your payroll runs for 8 weeks, your Form 941, state unemployment tax return, health insurance and retirement benefit statements, loan agreements, lease agreements, invoices, canceled checks, account statements, anything and everything that you can use to show that you paid these expenses in that magic 8-week period. The statute is confusing in terms of it says incurred and paid. Let's just say that. It says incurred and paid, okay? So whatever that means, you want to make sure you have evidence of that. And then you also want to have, for the reasons we just discussed, evidence of your average FTEs and your salary and wage information, which you will. Okay.
One thing I'll mention there quickly, Erica, you mentioned it earlier about the self-employed individuals who maybe haven't yet filed their 2019 return. Even if you haven't filed your 2019 return, you're going to need to submit your 2019 Schedule C. So you're going to have to go ahead and fill that out. And I would fill it out just as if you were filing your return, because you're going to have to make the I think the good faith certification that it's going to be similar to what is provided to the IRS.
Right.
So even if you're waiting on filing your 2019 return, go ahead and start preparing that, because you're going to need that if you're self-employed.
Okay, Dave. There we are. I bet we were so good there are no questions.
I think Dave may be on mute.
Well, we do have quite a few questions if you all are ready.
We're ready.
Okay, so the first question comes from David Sauerback. He wants to, first of all, thank you all for such a great webinar last week. It was incredible. He loved it. His question is, when we received their PPP, their bank automatically set them up for the existing SBA debt relief. So they've got like interest and principal payments being paid for the next 6 months by the SBA. They want to know if there is any SBA or Treasury guidelines on how they should treat those payments on their taxes and or financial reports. And also if there's any possibility they may have to pay that money back.
Yeah, so I'm not sure I 100% understand, which is fine. Yeah,
okay.
Go ahead, please.
Okay. So basically they got the SBA debt relief for their loan.
Yeah, but I don't know. That's what I don't know exactly what that means, Tony. Do you, John?
No, I don't really. I've heard of it, and I heard that I thought that the SBA debt relief was applicable for loans that weren't already on deferment.
Exactly.
So I'm not sure how that would translate to a PPP loan that you already have, deferral of principal and interest payments.
Oh, no. I'm sorry. I want to make sure y'all understand. He's just wanting to make sure if he's going to have to pay back that loan deferment payment from the SBA. He's just letting us know he got his PPP, and so the bank automatically set him up on the deferment. Will he have to pay back those payments?
So, so there it says two different things. It says the accrued interest is not forgiven, and then it also says the accrued interest in another place is forgiven. Let's pretend that it's forgiven, since they have come out and said that. And so no, you won't have to pay that back. In terms of how it's treated on your tax return, that's in debate. The IRS says, well, the statute says that the amount of your loan will not be treated as cancellation of debt income, which would typically be taxable income. So the loan itself, and presumably, the loan itself will not be treated as taxable income. And then the IRS came out either at the very end of last week, I guess, and said, nor can you deduct for tax purposes those expenses. No income, no expense deduction. And then Congress ran out in the middle of the street and said, wait, that is not what we meant. So there has been talk about that being corrected statutorily if there is some sort of fourth program, which I think there will be, to address state and local governments. So that is just still a little bit up in the air as far as the IRS is concerned. No income, no deduction.
Yeah, I do just quickly want to clarify that on the SBA, there is this concept of SBA debt relief program that exists where the SBA will actually make payments on a borrower's behalf on principal and interest. That is not available for the Paycheck Protection loans or EIDL loans. So I just want to make sure that that's clear, that from a borrower's perspective, you're still obligated to make those deferred payments, that the SBA is not going to step in and make those principal and interest payments for you as it relates to Paycheck Protection loans.
Right. Those are only on 7A or 504 loans, or any of the express loans that the SBA had. And so Tony, I've got a question.
Okay.
So I've gotten this from Kim and several other people, and I'm going to tack on a little addition to it is, what if you don't spend the PPP funds by the time is up, the period is up, and what if, here's my question, what if you spend the PPP money on expenses that are not allowable expenses?
Yeah. So two things, I guess. What if you don't spend it by the time that it's up? I don't know if that's on the forgiveness side or on just the general allowable use side there, Dave. But on the forgiveness side, I mean, if you don't spend it by the time the forgiveness period is up, it's not going to be eligible for forgiveness. Mm-hmm. If you miss the deadline for the allowable use, which is now June 30th, which we fully expect, as I mentioned earlier, to get extended, then you would just have to repay the amount. And so on the concept, and Erica, you can chime in here too as well, on the concept of if you use it for non-allowable expenses. I think it's in the Q&A or one of the interim final rules, but it talks about that if you use it for non-allowable expenses, you're going to have to repay the amount that you used on those non-allowable expenses. And if you used it intentionally and knowingly on non-allowable expenses, that you could be subject to further prosecution and penalties and fines, I believe. Is that accurate, Erica?
Right, and you have to pay it back immediately.
Gotcha. And that was in the guidance that came out recently, as far as that.
Yeah, so I couldn't tell you, Dave, where I've seen it. It's a blur.
Okay. Tony?
Sure. My next question comes from a entrepreneur who says, our business received the PPP and we have 3 employees and 1 1099 contract worker. The contract worker receives a percentage of the work she does. There is less work available for her to do. Will we be penalized if she doesn't get the same average amount of money that she did prior to COVID-19?
No, because she doesn't go in your payroll costs, either allowable or forgivable, believe it or not. So that was clarified, as I say, after the fact. But you don't count in payroll costs to amounts paid to 1099 folks. And so as a result of that, you're not going to be penalized. You're not going to be penalized for that amount being reduced.
Okay, thank you. The next question is, I have an entrepreneur who says they will be adding employees. No, sorry, the question is, will adding employees to ensure you use the 75% of the funds increase your odds of qualifying for forgiveness?
I mean, yes, theoretically.
Yeah, I think it's going to increase your ability to get more of those costs forgivable. But I don't, like we said, we don't know what the ramification is going to be for not hitting that 75% threshold. So to the extent that you have the ability to hire more employees, have work for them to do, and potentially have a job for them subsequent to that, then my recommendation would be go ahead and hire them in order to try to achieve 75% of your loan proceeds if you can.
Okay. So this question's a fairly long one, so bear with me. I'm gonna do it in parts. Okay. Okay. So due to COVID-19, I was forced to cut off my workforce. So I laid off my first employee, Joe Smith. I was recently approved for the PPP. The first question is, do I have to hire Joe Smith back to that position, or am I free to hire anyone to that position?
You can hire anyone.
Yeah.
Okay. Let me see. Then they also say, if I offer Joe Smith his position back, but he declines the offer, do I have to hire someone to fill that position in order to maintain headcount?
My answer would be yes.
Okay.
Erica, I don't know if your answer is different than is
Yeah,
it?
no, I'm gonna look. I'm gonna look at that last, the frequently asked question from Monday. Remember that one?
Yeah, while you do that, the only reason I hesitate a little bit on that is because there is a requirement that if you are offering employment, full-time employment to somebody who you've recently let go or who has been furloughed, and they refuse to come back, maybe because they're making more on unemployment than they would be on their regular wages, there's a requirement for the employer to notify the unemployment office of that extension of the full-time offer for that individual, and that they refused or declined that offer. Just because they refused or declined, I don't think that would then play into automatically you have a new full-time equivalent employee, to where it would kind of rectify that decrease. That's why I hesitate, but my answer would, go ahead, Eric.
Yeah, I'm sorry. And guys, I looked everywhere for that phone number that I could have sworn or email address that they gave to report those folks who won't come back, and I couldn't find it. So I apologize for that. And I was going to re-listen to what I was listening to, and that didn't happen. So earlier, the SBA answered this question. Will a borrower's loan forgiveness amount be reduced if the borrower laid somebody off, offered to rehire them, same employee, but the employee declined the offer? And the answer it says no, that this is going to be treated as a de minimis exception, that it'll be in this magical guidance that I'm waiting for. But that rule, which is that question, was 40. It says that to qualify for this exception, the borrower must make a written offer of rehire. So that's a little specific there. And then you also have to document the employee's rejection of the offer. Now, it doesn't say document in writing, but you better write it down. Yeah. And then it goes ahead and makes the next statement. Employees and employers should be aware that employees who reject an offer of reemployment may forfeit eligibility for their unemployment compensation.
Yeah.
So I got a question, and I've gotten several of these also, and it's kind of specific. This is from Wendy, actually. It says, 100% of my workforce is contract workers paid by 1099s. My loan was calculated and approved using 2019 1099 amounts. From your information, does this mean that none of my contract payments during the payback period of the PPP will be forgiven?
Yeah. So I sure hope not, because that information about the 1099 people, your independent contractors, came after the fact, after you applied for that loan. Mm-hmm. And so surely to goodness, they're going to be consistent with how they treated you before and how they treat you for forgiveness. So I can't say for sure. That it'll really be up to your lender. And I've got my fingers crossed for you, because that would be really, I know that this world is not fair, but that would be really unfair.
Yeah.
Hey, Dave.
Yeah.
I noticed this in the questions you sent to me. You guys are really good at answering each other's questions, and I love that. So somebody posted the website for where you can report refusal to return. Thank you so much, Gwen. I really appreciate that.
That's Kevin. So good. Tony, you want to take another question?
Sure. This comes from Paul Myers. He says, we are a single member LLC. We have no rent, interest, or utility. For years, we have paid one employee. Payroll is his only PPP qualified expense. Should he pay out once to stimulate and match his previous quarterly payments, or weekly or biweekly? So is there any logic to apply here? Should our payout match the way I documented the quarterly payout on our application?
You just want to make sure, Paul, that you make 8 weeks worth of payments in your covered period. I don't care if you do it once a month, if you do it the last day of your period, if you do it once a week, if I understood that correctly. Is that what you understood the question to be, John?
Yeah. The timing.
Yeah. Just make sure that that individual gets 8 weeks worth of compensation.
Can I ask another question now?
Sure.
Okay, thanks. You all have been awesome. So this next question is, can we give bonuses and can we pay back pay we could not pay before the funding?
So the bonuses, and Erica, I'll let you take the back pay one. The bonuses haven't been addressed. So right now, I mean, there's nothing that prohibits you from paying a bonus. There's nothing that says that you can pay a bonus. Just the one thing to be mindful of, as I mentioned earlier, is you want to make sure that within that 8-week period, you're not paying an individual employee salary or wages that would annualize in excess of $100,000. And so I think if you boil that down, I think it's somewhere around $15,385. So as long as the bonus, along with the other salaries and wages, doesn't exceed that, there's nothing right now saying that you cannot do that. As far as back pay, I'm not sure. What are your thoughts on that?
Yeah. So back pay, I would say, is not incurred in the 8-week period, and since it says incurred and paid, that makes it a little scary, right? To try to include those. I sure understand the sentiment though, and and you would think that would be allowable / forgivable, but it doesn't say that right now.
Okay. Okay, go ahead. Do employees on expanded FMLA count in the full-time employment if still on payroll?
Yeah, right now, we don't know. They don't have the definition of the full-time equivalent out there. They don't address whether or not people out on leave would be counted if they're still receiving wages as they would be for full-time employment. My opinion would be that they would still count towards your FTEs, but we don't know at this point. Erica, do you have a different opinion on that?
No. I think that's 100% right. I was giggling because I've got the chat box open and somebody typed, and I totally understand. Is there someone I can contact to answer these questions? If you find them, would you please send me the name and number? Because I need to know. The best place to go, though, point well taken, is your lender, and see what your lender is going to tell you, because they are going to be the one that decides whether or not, what amount is forgivable.
Yeah. I got a question from my good friend Lindsay, and she has some specific questions on unemployment and things, which is not really y'all's expertise, but she does have a question, and we talked about this earlier. As a single member LLC, early on applying for both PPP and unemployment, and the unemployment came through first, and then maybe receiving some PPP funds. What would you be opinion on that type of scenario? I know we get this a lot from folks.
Well, so I think there's a couple of questions maybe bundled in that scenario. The first one would be, might be, is my unemployment going to reduce my forgiveness? I think the answer to that right now is no, because your forgiveness, it appears, is going to be based on your 2019 Schedule C, K1, whatever, however you're treated for tax purposes. So I don't think it will be that. I can tell you already know that unemployment compensation is going to be taxable for income tax purposes. And that amount is probably, although I haven't looked at remember what I said at the beginning, I don't do these things, but it probably goes on the first page of your return, where if you had salaries and wages, you would have something on that line on that first page. So I don't know that it affects your business income. So those are the two two things I hear. Another question might be, can I keep the unemployment insurance now that I have this money? I theoretically don't know. I don't know. It's not that I think I don't know.
If the question is, can I continue receiving unemployment benefits and while I still have this, or I got the PPP loan, I think the sentiment is that you can't have both. So you would need to withdraw from your unemployment at the time that you receive those PPP loan proceeds.
Right, and then you would deplete your PPP to pay yourself, and then you could re-enter unemployment if you needed to after that.
That's right. Okay.
Tony, you got a question for us?
Yes, this question comes from Kelly. She says, if you are self-employed and are a sole proprietor, how is that 75% handled? That's the first question.
Well, let's assume, Kelly, so I don't know if you're the only employee. Can you tell, Tony?
I'll read more of a question. This might help some. Is anything that you would put on Schedule C as a 1099 eligible to be forgiven?
No. Anything on Schedule C that is on a 1099.
Mm-hmm.
Yeah, no, we're not going to be able to get those 1099 costs unless, like we were talking before, it happened to have been included in your loan application. I mean that I would. So what I'm thinking is the SBA issued a document. Well, the third IFR talks about self-employed individuals, Schedule C filers. And it says forgiveness for the Schedule C filer will be limited to 850 seconds of the amount on line 31. And 850 seconds is 0.15385. If you multiply that by line 31, then that is what's forgivable if you're a self-employed person. In that first IFR, when they came out and said you do not include 1099 folks as contractors, as payroll, as you don't include those as part of your payroll cost, that's what makes me think that you wouldn't be able to recover any amounts related to that 1099 expense on the Schedule C. That's what my head tells me, but yeah.
Okay, thank you. John, did you want to add anything before I go into the next question?
No.
Okay,
Nothing.
thank you. Okay, so the next question is, what if the loan proceeds received are more than can be spent on payroll during the period? For example, our weekly payroll and other allowable costs will be approximately $800,000, but the loan was $1 million due to the 2.5 factor on payroll expenses. Mm-hmm. Do we just return the funds, or if we spend it on other expenses, would it bring us below the 75% of payroll?
Well, I guess that's assuming that there's no other non-payroll type cost to spend the loan on. Right, because if you got $1 million loan and $800,000 to spend on payroll, technically you still have $200,000 that you could spend on covered utilities, covered mortgage, covered rent payments, and have that be forgivable. To the extent that you can't pay that and you have excess loan, that's really a decision at that point as to whether you want to keep those loan proceeds and repay those over the term, or you just want to pay those back and avoid the accrued interest that would amount during the payback period.
Yeah. And that's what we've been suggesting. Now, I think the next really interesting question is going to be how the lenders handle all this repayment of loan proceeds that's coming back, because they're not going to be prepared for that, because nobody's supposed to make a payment for 6 months. But I'd take that $200,000 and keep it in a separate little accounting poo, and then send it back just say, hey, I don't want to pay interest on it. I know it's not very much. I don't want to pay. I'm conservative. So here, take this money back.
Okay. So Juliana says, thank you all for the info. And she says her question is, I own my business and I've been taking draws as a member of my company, and I was planning on getting on payroll anyway. Can I add myself to payroll like I planned, but due to the fact of COVID, I won't call back because I won't call back every single one of my employees. Adding herself will bring her payroll closer to the amount that she used to calculate the actual loan amount.
Yeah, go for it, baby.
I got a question from Ann. Ann, we were just talking about coffee this morning, so I'm glad you're watching today, Ann. Ann owns 2 businesses and received PPP money for both. Would they combine my salaries for both businesses when calculating that annualized 100K salary restriction or not? So she has 2 separate businesses. She pulls the salary from both of them.
What's the so I guess what is the entity type? I think that'll make a difference. Or how are you reporting it for tax purposes? Do you have 2 K1s? Do you have 2 Schedule Cs?
Yeah, they're 2 LLCs. I do know they're all separate with their own tax returns and individually owned, not owned by a umbrella entity.
I
They're
don't.
the same people, though.
Yeah, I don't think if you report them together for tax purposes, then yes. I think if you report them separately, I'm going to lean toward no, because they shouldn't. I've seen they shouldn't combine those. John, what do you think?
I agree with you. I agree with what you just said.
All right, good. Thanks, Ann. You owe me coffee now.
She says one is an S corp and one is a C corp. Yeah, no, they shouldn't combine those. Yeah. 2 separate corporations.
Yeah. Tony, got a question?
Yes. Our Kim Sears says our covered period ends June 8th. This allows for 2 rent payments. If we have till June 30th for additional expenses, can I pay 3 rents?
Yeah.
Yeah. Don't you think so, John? Yeah. It won't be forgiven, but yeah.
Okay. On this one comes from Maryland. On the payroll cost, what taxes are forgivable? Also, is the total cost of healthcare forgivable?
So the taxes withheld from the employees are forgivable, and the state unemployment tax paid by the employer is taxable. State unemployment, if you're not in Kentucky, but you're on this seminar for some reason, then some states apparently have local unemployment taxes. Those would be includable. You cannot include the employer share of FICA. And what, Tony, remind me of the second part?
Let me see. Hold on. The total cost of healthcare. Is that what the total cost of healthcare forgivable?
So not knowing 100% what constitutes total cost, if you're talking about the premiums for your healthcare, for your employees, yes. If you're talking about I'm self-insured and I'm making claim payments, I don't know.
I got a question from John. Good to hear from you, John. Is there a quick reference calculation for forgiveness if you're not at the same head count from the same time in 2019, even though there is no work for employees that were laid off? And this is what we see, what we talked about earlier. You know, if you're a restaurant, you're not allowed to work. How you calculate that? And you guys certainly have come across this a lot. I'm wondering also, is there a spreadsheet or something you can share with people that they could do some quick calculations? You know, where would one find something like that?
Oh, I'm sure the Googly can find one for you.
Mm-hmm.
Yeah, the forgiveness calculation at this point, given the complexities around it and the unknowns, it's really, really difficult to have an all-inclusive calculation. So some people have pieces of it that they put out there. Some people have put out a full calculator but made a lot of assumptions that really aren't in the CARES Act at this point. So I don't know of a good one that walks somebody through from start to finish the full forgiveness calculation that takes into account those reductions as well as the potential rehire exemptions that we covered, especially on the rehire exemption piece. But the question related to how is that going to be treated from a full-time reduction or full-time equivalent employee reduction if I can't go back to work? It's an excellent question. And that's something that we just don't know how that's going to be addressed at this point. I don't know if that was fully considered on the front end that, these state-by-state regulations would be phasing in businesses and maybe restrict businesses from even being open right now. So if you can't be open for operation because of a state law and regulation, then how are you going to bring those FTEs back during that time period? And then I think the question is you can't. And so are they going to cause a reduction to your forgiveness amount because of that? We don't know at this point. We can assume based upon reasonableness, but we don't always know if they're going to be reasonable.
Yeah, let's hope that de minimis exemption is really broad, and that we have a very wide understanding of what constitutes de minimis, which is an oxymoron. But okay, so is interim final rule.
So Tony, it's getting a little late here, so let's take one more question. What do you got there for us?
Okay, so we have been paying our employees out of other business funds because we have not received the PPP funds yet. Can we reimburse the business account for that amount?
My answer would be no.
Ouch.
Because your 8-week period hasn't started yet. What do you think, Eric?
Yeah, no, so it won't be paid in that covered period. I don't know. That's tricky because I could argue when I get my money and I make a payment to my other account, if that's what you're talking about, that's when it was paid, but it wasn't incurred in the 8-week period. So no. Yeah, no, John's right. It's a common feeling.
Well, I want to thank you all. Thank you, John and Erica. You all have been so awesome. Thank you. I'm going to go ahead and hand it over back to Dave. Thank you.
Yeah, I want to just say my thanks to you. You guys are a wealth of knowledge. I know everybody appreciates it. And just by the number of questions we got, I know we didn't get to a lot of them. We had a little technical problem last time, but we're going to go ahead and download these questions. We'll hopefully get some answers for everybody. We can share what we find out with everybody on this. You'll also receive a replay of this webinar sometime tomorrow that you can watch at your leisure time and time again. And,
that's frightening.
As always, we'll be back next Wednesday. And just as a little heads up, next Wednesday, we're going to be calculating, or we're going to be taking on the question of safe reopening practices for retail and other businesses that are now going to be allowed to operate here shortly. So with that, I'd like to say goodbye to everybody, and thanks for attending. And thanks again to Erica and John. I think you guys are the most popular people on the planet these days. And we certainly appreciate everything you've done for us. And we'll be seeing you soon.
Thank you all so much.
Thank you. Appreciate it.
Goodbye, everybody.